welcome to Clarkenomics. In this video, we're going to talk about the banking system for the very first time. Just jumping right in here, starting off with banks. What do you do at banks? Well, at a bank, you can deposit your money, right? So if you have some cash or someone's given you a check or something like that, you can go ahead and deposit that. That's the primary reason why most people use banks. What do banks have to offer? Well, they give two main benefits. One, security. You don't have to keep that cash on you or in your home where it could be vulnerable to being stolen. You can put it into a bank where it will hopefully be safe and protected, right? So that's the first reason. Money is a great store of value, and banks offer security for savers. And the other reason is that banks pay interest to their savers. And so this is something that I'm finally getting to talk about now since we did simple and compounding interest in other videos. So here's how this works. When you put money into a bank as a customer, you're putting your money into your bank, whether it's like a local bank like WSFS, WSFS Bank, or Capital One if it's a national bank, you are lending the bank your money. You're giving it to them to hold on to for you, but you're actually lending it to them. They're keeping it safe for you. But not only that, they're going to pay you for letting them do that. So they're going to pay you compounding interest when you put your money into the bank. So when you put money in your checking account, you are actually a lender in this situation. And that's why the bank is going to pay you interest. So typically speaking, interest from banks is compounding, which is great for you because you are the lender. So you're going to earn more interest there. So how to get your money once it's in the bank? Well, there's a lot of ways depending on what type of account. But the primary ways where people access their money is they make a withdrawal at the bank. So they'll go to the bank with a withdrawal slip, and they will ask for a certain amount of their money from their account. If you don't want to go into the bank building itself, you can also find an ATM. Just be careful though, because if it's an ATM not from your bank, you might have to pay some fees, and those fees can add up quite a bit actually. So be careful about what ATM you're using. Other ones are free to withdraw your money from. So it depends, just look out. You can also use something called a debit card. That's something a lot of people have. And you can also, it's a little bit more old-fashioned these days, but you can also write a check. So there are lots of ways to access your money, again, depending on what type of account it is in. But that's the main reasons why people put their money into banks. The bank will keep it safe, and they'll also pay the saver interest. Okay, so let's kind of talk about the main trade-off here of spending a dollar versus saving a dollar, because every time you're given a dollar, you're faced with this decision. Do I spend that dollar today or do I save that dollar today? Now, if you think about it, a dollar that you save today is a dollar that you can't spend today, right? So if you're saying, I'm going to save this money, I might need it later, you are foregoing, you're giving up the opportunity to spend it. That's why the opportunity cost of saving a dollar today is consumption today. But on the flip side, a dollar today that you spend is a dollar that you can't save, right? If you spend the dollar, you get something, but it also means you're giving up the opportunity to save it. So what's the opportunity cost of spending? Well, the ability to save, but not just that though. You're also giving up interest, right? Because if you saved that money in the bank would have paid you some interest. Now, if you're saving it under your mattress, that will not be the case. But if you could have saved it in the bank, you're giving up the opportunity to earn interest if you spend that money instead. So, a little bit of practice just with interest rates. We had done this in another video called compounding interest. Let's imagine that your bank pays you 3% interest compounding annually, which sadly is actually a higher rate than you would probably get in real life. For a long time, I got paid less than 1% interest. Bank account interest rates are pretty lame. But let's imagine you have 3% compounding annually. Let's say you put $100 in your bank account today. If you didn't touch the account, for 20 years, what would your account balance be at the end of that time? And so as we've done before, you want to set up your formula where $100 is your principal, your initial amount. 1, there's your interest rate expressed as a decimal, 0.03, to the 20th power, which corresponds to how many years you're leaving it in the account, which is the same as 100 times 1.03 to the 20th power. And 1.03 to the 20th power is 1.81 times 100. This is easy now, is $181. So your money would almost double, almost, in 20 years if you didn't touch it with a 3% annually compounding interest rate. Now, the good news, even though bank interest rates are pretty low, definitely lower than 3%, they do compound more frequently than once every year. So you would, make up for a little bit of that low interest rate with a more frequent compounding. So that's the good news. All right. So let's get to some practical information on types of bank accounts, right? Because we have done a lot of great work with economics so far, but not all of it has really pertained to personal finance and stuff that you might use on a day-to-day basis. This is where we get to do a little bit of that work. So the most common type of account you might have heard about is a checking account. So a checking account is a account in the bank where you can put your money, and the primary advantage of a checking account is what we call liquidity. What liquidity means is that you can access your money more easily. It's not locked up in something that takes time to get to. If you need money out of your checking account, you can get it real fast. That's what liquidity is all about. How fast can you turn it into cash or purchase? So, if you're using a checking account, you can write a check from your checking account. You can use the electronic form of a check, like a debit card. You can pull your money out of an ATM. There's thousands of ATMs in our area. Or you can go to the bank and make a withdrawal. So there's lots of ways to get your money. Now, the downside of a checking account is the interest rates are absolutely minimal. They're so low. They barely pay any interest at all. And so for that reason, more liquidity, less reward. The other main type of bank account is a savings account. These provide slightly less liquidity. They're more liquid than they used to be. Um, you can still take money out of a savings account with an ATM. You can still go to the bank and make a withdrawal from your savings account. You can even transfer money from your savings account to your checking account if you want to. But one big limitation that the government imposes on savings accounts is you can only withdraw money from a savings account 6 times per month. Those accounts aren't designed to have people putting in and taking out money constantly. They're designed for people to put in money and let it sit there. And for that reason, savings accounts pay a slightly higher interest rate than checking accounts. Again, nothing to party about, but the interest rates are just a little bit better. So those are the two main types of bank accounts you might have. If you were to log on, because most people check these things online or on a phone these days, you would see something called your balance. This is another piece of terminology that's important to know. The balance in your checking or in your savings account is the amount of money currently in your account. How much money do you got? That's what your balance is. Now, it's important to maintain a certain balance in your account, meaning some accounts out there have what are called a minimum balance, like $100. You have to keep $100 in your bank account, or they're going to charge you fees to use that bank account. If you keep over $100 in your bank account, then you're good. It's like a free bank account. But if you don't, they might charge you. So watch out for that. A lot of the bank accounts they advertise to young people typically don't have minimum account balances, but that's that fine print you want to read carefully, because if not, when you have when you have the least amount of money, that's when they're going to start charging you, which as a consumer is infuriating. So make sure that there's no minimum account balance if you have a bank account. There's plenty of options out there for banks that don't charge minimum account balances. And for many of you who are watching this video, you're under the age of 18. While you cannot yet open your own bank account, you can use what's called a custodial account, which is controlled primarily by a parent or a guardian until you turn 18. And then you can take control of that account after you turn 18. So just because you're not 18, don't think to yourself, well, I can't save money, I can't have a bank account. You absolutely can. You just need a little bit of help from your parents and or guardians. So here comes some more practical information. Um, every month, your bank is going to generate for you something called a statement. A statement is a document that gets sent to you. Now, traditionally, this would come in the mail, um, you know, envelope, paper inside. These days, most banks, if not all banks, will let you opt to get electronic delivery, so you're not wasting paper and all that stuff. So you'll just get a PDF on your bank account website. And what this shows you is your balance, like at the time of the statement, how much money was in your account at the time of the statement, and all of your transactions. So you can go through and see like what money was spent on if you wrote a check or if you used a debit card or anything like that. You can see when cash was taken out, from what branch or from what ATM was cash taken out. You can track all of that stuff. Now, there's a little bit of a delay. These days, it's not that big of a deal because if you log on to a bank's website, you can instantly check your account balance, like to the minute. Statements are just a once a month document that gets sent to you. Statements are important if you're doing things like trying to apply for a mortgage, get a student loan, a car loan, something like that sometimes, um, because those lenders want to see how much money you have. And those statements are the official records of how much money has been in your bank account. So, the next thing is overdraft. Overdraft is the worst. Overdraft happens when your account balance of your bank account goes negative, meaning you have less than $0. You have negative dollars. Well, why might this happen? This might happen because let's say you have $5 left in your bank account. That's your account balance in your checking account. And you forget about that. And you go to the store and you buy something for 10 bucks. Well, if you had $5 in your bank account and you went and spent 10 on your debit card, your bank is going to do one of two things. They're either going to decline that purchase, meaning they're not going to let you buy that thing. Like your debit card, when they try to run it at the store, is going to be like, nope, you don't have enough money. Or the bank will let you buy that thing with your debit card, but now your bank account has negative $5. And when that happens, the bank is technically lending you money, right? Because you don't have that money, they still let you buy whatever thing you were trying to buy, but they cover that with their own money, the bank's money essentially. And so a lot of banks charge you what's called an overdraft fee for that privilege of borrowing money from the bank. However, these fees are absolutely ridiculous. A lot of the time, they are $35. So even if you overdraw your account by like a dollar or even like a couple pennies, they'll charge you 35 bucks, which means if your bank account was negative 5, now it's negative 40 because they've charged you $35 on top of that. And if you let that negative balance stay for a while, they'll keep charging you overdraft fees. So it is easier than ever today to check your bank account balance. You know, you can use your phone, you can use the internet, whatever you need to do. So make sure that you know what your bank account balance is and that you're not writing checks or using your debit card and buying things that you don't have the money for. Because you can rack up some pretty hefty overdraft fees really quickly if you're not careful. So you got to be very careful. Now, this is an image of a debit card. You know, it's pretty typical. You have your bank's name. Debit card numbers have 16 digits. They're grouped in groups of 4. It will have what's called an expiration date, which is right here, 4-digit number. And it'll have your name right there across the bottom. Your code, there's like a special security code that'll be on the back of the card. Traditionally, they wanted you to sign the back of your card as well. A lot of people don't do that these days. A lot of people don't even use these cards directly these days. They might have it routed through um, Apple Pay or Google Pay or some other electronic payment service. You might probably won't even hand your card to a person anymore. Usually they have the readers now where you just stick the card in and it reads the chip and you don't actually have to hand your card to a person. Restaurants are a bit of an exception to that. You still have to, in the United States anyway, hand your card to a person, which is a little old fashioned. Um, and then this is a check. So when you look at a check, you'll have some basic information about yourself, name, address is all there. Every check has an individual number, which you will find in 2 places. You'll find it here in the upper right corner, and you'll find it one more time down here. Every check has a number. And then you will write today's date, the day you're writing the check. Do not write a future date here. You always want to write the date that it actually is right here. That's called post dating when you write a check and put a future date on there. So don't do that. And this is the person who you're paying or the institution that you're paying. That goes there. And you want to write the amount of the check right here using numerals. And then in words, you write out the amount of the check right there. A lot of people like to write, you know, $5, and then they'll draw like a line right there to make sure nobody can add anything after what they've written if there's extra space. That's a habit some people have. And this is called the memo line down here. So whatever the check was actually going to be used for, that would be written there. That's really good if you write a lot of checks and you might forget, you know, oh, wait, what did I write that check for? Because when you log on to your bank account online and you've written a check, there's usually an image of the check you wrote. And so if you wrote something on the memo line, you'll actually be able to see what you wrote that check for. And then this is where your signature goes. The check is not valid without your signature. It cannot be used without that there. If you ever make a mistake, don't just throw a check away in the trash. You would want to write the words void across it, just like that, in pen, so that nobody can later use that check. There is also personal information about you on a check, so you have to be careful. At the bottom, whoops, there are two numbers. This first series of numbers, this is called a routing number. This does not belong to you. This is the bank's number. So the bank that you use, every bank in America has a specific routing number. You want to look at that number and you can see that bank's routing number. And then this is the information that's personal to you. This is your bank account number right here, your bank account number. So be mindful of that. You don't want to throw away checks a lot, or if you do, you want to write void, you want to shred them, because this is your personal bank account number that's written right down there at the bottom. And then one more time, this is the check number. So that's some basic information about checks. People don't use checks as much as they used to, but there are still probably going to be some things in your life where you end up writing a check for them. Okay, and to close things out, we're just going to talk about the role of banks, not just for you as a consumer, but overall in our economy. Um, when banks take your money, they accept your deposit. They don't hold on to it in the safe, like locally at your corner store, bank. Most of the money that you put into the bank, they lend it out to other people to use. So when they do that, they charge those people interest, right? They're lending, so they'll charge those people interest. So they might charge somebody 15% on a loan, but they're only paying you, the saver, 2%. That's something that we call bank spread. It's the difference between the interest rate they charge other people and the interest rate that they pay you. And that's one of the ways that banks make their money, is by charging people more for loans than they pay you for putting your money in the bank. So, who are these people who borrow money from banks? Well, there's lots of reasons. Tons of people borrow from banks. Why? Well, they might need to borrow money for college. They might need to borrow money to buy a house. That's called a mortgage, is a house loan. They might need money to buy a car or just to purchase regular stuff, home improvements. Could be anything, medical expenses, sadly. There's lots of reasons why people borrow money from banks. In addition, businesses borrow money. Businesses want to invest in themselves and they want to grow their business and become bigger and better. To do that, they might need to borrow money. Whoops, that got cut off. So banks here serve as an intermediary. That's a bridge. They take money from savers, who function as the lenders in this case, right? When you put your money in your checking account, you're lending the bank money. They take that money, that savings, and they channel it to borrowers, such as people and businesses. So that's what banks do. They're what we call financial intermediaries. They take money from one party, channel it to another party, and everybody benefits in the meantime. So that's just some basic stuff about banks and how they work. Thank you for watching.